Hello, friends. I'm Cynthia Meyer with Real Life Planning, and this is the Real Life Planning Podcast. And today I'm really excited to talk to Bill Can with Candon Capital. Bill and I are in the same mastermind or coaching circle together, and we've been working together once a week over the past almost 3 years now, right, Bill?
Mm,
Uh,
I think so, yeah.
and it's been a really beneficial group for both of us. I'm really happy to introduce you to him today. And let's start off. Bill, tell us a little about what's important to know about you.
Oh, wow. Thanks, Cynthia, for having me. This should be fun. I'm very excited about doing this. What should people know about me? My background as in terms of becoming an advisor is different from most advisors in that I'm a career changer, but not really. I have been in finance and economics for my whole career for about 30 years now. And I guess what really differentiates me is not just the time there, but I spent basically 20 years on the institutional side. I had the distinct opportunity of having been a desk economist covering the bond market. And then my bond friends thought I went to the dark side when I crossed over, became an investment strategist doing small cap stocks for about 7 years. And then had the opportunity to transform myself again, where I covered emerging market equities. I joke and say, gee, I'm almost following the Madonna plan. Every so often, she remakes herself and has decent success doing that. So it was pretty cool to be able to see different markets while doing small caps. We also launched research reports on private equity. So it's unique in that I got to actually see firsthand and be involved in many different markets during my research advisory career. I bring that to the table and have my share of stories to share. Hope some are fun, some are not so fun, but lots of stories for sure.
I really hope we can dig into some of those today because as we're recording this, the markets in the US are really volatile. The international markets are generally down as well. The bond market is down. For many younger listeners, they may not have ever had significant capital in the investment markets in this way in their adult lifetimes. So
Mhm.
for those of us, and we don't have to say how old we are, but we've been at this for a while. So we've seen the dot-com bust and the financial crisis of the Great Recession, the COVID recession in 2020, and lots of little ones in between.
Mhm. Mhm.
So we've buckled our seatbelts, but hopefully today you can share some guidance with folks about what they might be able to do during this period of volatility. What do you do when things aren't going the way that you want them to?
I think, first of all, expect that to happen. That's the natural course of events as an
Yeah.
investor. Although it felt that way for a few years, that it only goes up one direction
Mhm.
and it only goes in double digit levels. Look at history or look back in time. There are ups and downs. The most successful investors are those that figure out what's right for them and they stick to it. That starts with doing something sensible as opposed to very speculative. If you want speculative, you can always buy a lottery ticket and see how that goes as an investment. It doesn't work well. One thing interesting about investing, at least in terms of the assets that most advisors deal with, stocks, bonds, real estate, and so forth, is that they have a track record. You know how they work. They're regulated in a good way because there's some protection with regulation. And the odds are actually in your favor. They will have ups and downs, but if you're there long enough, things will work out well for you. In contrast, that the odds of you playing the lottery ticket, odds are you're going to lose money. You go to Vegas, the odds are you're going to lose money. Here, it's like a win-win situation if you have a long time horizon. So I rather play and choose that game and play it if you as best you can.
Mhm.
And it,
So staying at the table, right? Staying in
yeah,
your seat over a very long period of time. I deal mostly with real estate investors in
mhm,
my practice. I think one of the reasons that people are able to stick with it for such a long period of time and realize the returns that come with that, right, is because your property or properties are not marked to the market. Price discovery is hard, right? Either
mhm,
you have to get a property appraised or you have to sell it for a certain amount of money in order to know exactly what it's worth. Whereas with our 401ks, for example, or taxable brokerage accounts, we can literally watch price changes minute by minute, second by
mhm.
second when the markets are open. Do you think that has a big psychological effect on people's ability to stay seated at the table over a long period of time?
I think yes. I think it's not, it goes beyond psychological, even in terms of the actual numbers. it'll show that they're less volatile. And to me, that's a fallacy. Just because you can't see it doesn't mean that it's not there. I'll joke with my mom, she's elderly, and I would say, oh, that's salty. And she's like, I don't taste it salty, therefore it's not salty. No, I know the salt content. It's actually high. So
Mhm.
be careful. And it's the same thing, right? Even if you don't see the volatility, it's there. We used to do that a lot when we launched a private equity research report series. With private equity, like real estate, you don't see transactions happen all the time. The general rule of thumb for the way people account for it is that if only when there's a transaction, you mark it up or down accordingly. If you think of it that way, if you don't do a transaction, it stays the same. There's no volatility. By a lot of people's eyes, you would say it's not risky that I didn't lose money. And in terms of some performance reports, you'll see for some private equity, like their volatility is actually lower than it is because there's no mark. And it doesn't make any sense because I can say this is a smaller company. It doesn't trade. It's less liquid. They don't have strong market dominance. In the public market, public equity market, smaller micro cap stocks, usually those things have wild swings.
Mhm.
So why, if you take it private, does the valuation all of a sudden stop changing? Markets are actually very related and you have to do your homework and all that stuff, but don't fool yourself. If you don't see it happen, you may just not be aware of it. Imagine trying to sell something like the white desk behind you, Cynthia. All of a sudden you say, I want to sell it today, right now. What price would you get? And there's really no market for it. Is it whatever you want and you market at that price, or you market at the price that the first buyer gives you?
And people might market at the price they paid for it, even though I'm sure that's not what it would be worth if I were to sell it. Yeah.
Exactly. Imagine buying a used car, right? The once you own it and then you sell it immediately, even if it's like a day old, the
It's
price has
weird.
changed, except for today. Maybe it's still high, but normal
This is
cases,
a weird period in history because it's because there aren't enough cars available for people that want to buy them. But
Yep. I would apply some of those rules of thumbs to keep yourself honest. Look at related markets if you can. Are they changing, right? If you think about it, for real estate, for example, if you see your neighbor sell their house for a lot more money than what they bought it at, you would say, oh, things are up, and you mark it up. But if there's no transaction because market's down, what do you say? Do you say, I'm going to lower it by 20% because somewhere else it's down 20% far away
Mhm.
from me? Or would you say, I don't know what it is exactly, which is probably the honest truth, but odds are it's down because things are being marked down elsewhere. And the cost of financing, like mortgage rates right now, have shot up. Those are all things that affect prices. It's not a simple question, not a simple answer, unfortunately.
Mhm. Can we dig into volatility a little bit? Because I found in my years as a financial planner, that's often something that people don't fully dive into when they take a risk tolerance assessment when setting up an account or
Hmm.
when getting started on a retirement protection or any kind of investment strategy. What we mean by volatility really is the variation in returns of an investment, looking in the rearview mirror, what
Hmm.
has happened historically. If there's any other simpler way that people could think about it, I would really like to hear the ways that you explain it to clients. Often investors focus on the upside number without fully understanding the implications of the downside numbers. If something could has historically the possibility to go as high as say 35%, it has the possibility to go as low as minus 35% depending on the asset. What would you suggest that people do to think about those principles in terms of their implication to how they should remain invested?
That's a great question. We talk about volatility, but for most people, they might use the term risk. If you practice modern portfolio theory and you run these optimizations, what you're trying to do is maximize return. And at the same time, you're trying to minimize risk.
Right.
And risk is standard deviation. People definitely always forget standard deviation. It doesn't discriminate. It treats the up and the down the same.
Mhm,
Most investors, they
mhm,
care about the up. They don't mind upside volatility. They'll
right.
take the upside. I'll take it all day. The downside is what you should really focus on. Well, depending on the practitioner or you as an investor, a lot of times the focus on the downside, right? And in terms of sticking with it, how much can you stomach? Can you stomach the risk? I like to think of it also as your capacity to handle risk. Before we talked about staying invested, you want to be playing the game. The thing is not, I want to play the game and be at the table. That's one thing, but I still need my enough chips to stay at the table.
Mhm.
Once I ran out of chips, game over. Sometimes for investing, the strategy takes time. Day traders think in terms of minutes or days, but for long-term investors, it's not even a year, but
Mhm.
decades, generations. You have to figure out how much can you risk and still be in the game.
Mhm.
So if you already borrow lots of money to invest, a margin call where something falls in price and the bank or the lender says, hey, you have to pony up now, otherwise we're going to stop you. That's not good. So if you're levered up, or in real estate, if you're over levered and all of a sudden you're not getting the cash flow to cover your debt payments, that's a problem.
Mhm. Especially in the commercial space where a loan could get caught. Yeah.
Yes.
Uh,
And we saw that in the Great Recession between commercial,
mhm.
between residential, where people were betting that they can refinance and get a lower
Mhm.
rate, right? At least one of the things that was going on there. Situations stopped happening. They couldn't handle the risk. The risk in that case was what the ability to refinance
Mhm.
at a lower rate. And for an investor, what they should really think about is trying to understand for themselves or with the help of their advisor the mechanics of what's going on. What does it take? It's not just like, oh, I have a bunch of money and or wealth, and therefore I can play as long as I want. No, not really, because you bring in other things too, right? At least that's why I like to think about it. If you can make lots of money, you can pull in $5 million a year. But if you spend $6 million a year and you have all these risky investments going on, you have really little capacity for risk. One thing
Mhm.
goes wrong, the house crumbles and you can't really
Mhm.
keep staying playing the game. What I would suggest is understand the concept of what's important to you. And then also, what do you have? Something always goes wrong. It's like a
Mhm.
pothole on the road. What happens? Are you equipped to absorb it and keep rolling? Or you hit the pothole, you're going to get a flat tire, and boom, you pull over the road, and that's it. You have to wait
Mhm.
and spend time hoping for help and all that stuff. You really have to understand your situation and how you're stacked up. I even think our goals as a liability is something for myself. If I have a high priority goal, I can't risk it. If I take on too much risk and something go bad, it's not only just losing money, I lost my goal. So can you handle that?
Ooh,
Right.
I think that's really interesting from a paradigm point of view, right? Is to think about funding your future retirement or your future college goal or whatever as a contract that you make with yourself.
Mhm.
You have to go and make a payment on it regularly. How can people think about this negative feedback that they're getting right now in the past month or so as we see the stock markets in the US falling around the world? How can they not get so tethered to the best day they ever had in their portfolio?
Mm, yeah. I guess the standard advice is don't look.
Yeah.
Uh,
Yeah, I looked at my accounts yesterday. I didn't feel that happy when I looked at them compared to, say, 3 months ago.
that's easy to do. I think a lot of times we fall to doing what's the easiest. What I like to remind people of is what were we expecting to get anyway? Not just
Mhm.
the highest point, right? Let's say the last 5 years. If we were aiming to be up 5% a year. And we had this period where we had this big up and big down, and we're still up 8 per year. We're still well ahead of the game.
Yeah. Anchoring to the goal instead of
Anchored to the
the
goal or
highest
anchored
price.
to the history, what were you expecting to get?
Mhm.
Because honestly, sometimes things happen really well, right? Like investments just work out really well and you're super happy. And depending on the investment or, the particular security or whatever, sometimes I'm actually really concerned and nervous when that happens, when things do too well. Imagine you buy an ETF or some mutual fund and it does really well. I would ask myself, why did it do so well?
Mhm.
Did they do something that they were not supposed to do? And if they did, they got lucky or whatever. And I'll take the luck, but I don't want to count on it. In fact,
Mhm.
you're adding risk to the portfolio that I did not agree to. I thought you're going to buy large cap stocks and I expect returns to be whatever, 6% a year. For the people that do some deeper work, like portfolio managers selecting securities and whatnot, they'll find out that a lot of active managers, they do well because they go outside of their universe.
Mhm. So they make some tactical bets, if you
They make
will,
some,
to try and get excess return in the portfolio.
yeah, and they do. They're skillful
Mhm.
and they do that by going outside of their sandbox. In some cases, I may have agreed to that. You can go out 10% of the time. But if they overreach that, then flags go off and people should be aware of that. When things would go too well, it's like, why did that happen?
Mhm.
Is it sustainable? And even right now, I'm thinking about calling the current period the great deflation. Things were great and these companies were super strong.
Mhm.
But if you think about what was built into the price, there's very high expectations. When I was an analyst, we used to joke and say, this is price for perfection. When perfection or the environment changes, you can't sustain that perfection anymore and the prices will come down. So right now, Fed's raising interest rates, inflation's running, and everyone's agreeing that the Fed is more and more behind. So they're going to have to be more aggressive. The risk of inflation is higher. Companies are announcing, like one social media company a month ago said, we're good. And now recently in their earnings report said, well, things have changed
Mhm.
rapidly in the last month.
We're seeing a lot of that, especially on the consumer facing side.
Mhm.
Companies are pulling back on earnings expectations.
Exactly. So you have a change in expectations. That perfect picture that we all painted,
Mhm.
at least that was baked into the price, is no longer true. And that's, in a sense, a risk now. We don't know exactly what's going to happen. People are selling, the prices are being deflated. But then, as an investor, you might get frustrated and you're anchored to that. At the same time, I talk to some folks and say, we're also at a time where people are throwing a baby with the bathwater type of situation.
Mm.
Can we buy quality companies that will, last the test of time? And yeah, in a sense,
And get them a little bit cheaper than we could
a-
have 6
and
months
get a
ago.
little bit
Mhm.
cheaper. Yeah. And I expect them to last and I expect them to grow. We'll ride it. And hopefully, as a long term investor, you're in a position,
Mhm.
the resources to do this. And
Well, it's a wonderful period in history, right? For those people who have cash sitting on the sidelines in general, is to think about what to go shopping for and when and how much, depending on how long people think this is going to last. But just in general, without talking about any specific opportunities in this market, although I'm curious as to what you think about where the opportunities are. What is that quote from Warren Buffett? I think be fearful when
hmm,
people are greedy and be greedy when people are fearful.
yep. Hmm.
You know, is to think about where can you buy quality assets as an investor, and that could be buying individual stock, or for somebody who is just getting started or has smaller amounts to invest, or it could just be picking up the mutual funds or ETFs that you like, and maybe making that IRA contribution early so you can get a little bit more in the market at the right time. Now, in this period of month, I personally don't worry about it very much, but I'm mindful of the fact that clients are worried about it a lot. There's so much financial theater. I listen to Bloomberg in the car, you turn on the TV, and everybody's trying to get attention on the latest disaster, if you will. But it's like the weather, right? Like it's always good and bad.
Yep. Yep. I think one thing I like to remind people of is that, especially in the media, fear sells,
Yes.
misery sells.
Mhm. Which is
And
really annoying, right? Because
which is really annoying,
yeah.
really disappointing. And I think it's a disservice to people because you're not presenting both sides to the picture.
Mhm.
There are some real problems. I'm totally admit that, but there's also the other side too.
Mhm.
I think for a lot of people, it's a difficult time. I mean, it's a horrible time, especially if you said to yourself, I'm retiring this year. All of a sudden your portfolio lost 20%. And it's like, whoa, maybe not.
You might have to change your idea. Yeah.
Yeah. And so the question is, how are you positioned? Can you handle it? Did you give yourself that cushion? If you are living paycheck to paycheck, there's no room for error. In this case, if you're, about to retire and you're still like that, the environment has changed and you're banking on that peak number
Mhm.
from like end of last year, you didn't have that cushion. And unfortunately now we're stress testing it. Ideally, we prepare ourselves and our clients to be able to handle these situations. It's like having a shock absorber in your car, right? It springs. If you didn't have that, the ride would be so hard. It would be
Mhm.
horrible. But sometimes you can go faster when you're like so lean and mean, just like our supply chain, right?
Right. That would be nice if it went a little bit faster right now.
Hmm.
Tamp down
Yep.
some of this inflation. That's what cash is for in your emergency fund, or in your business cash reserves, right? Even though sometimes it can be frustrating to keep this pot of cash on the sidelines. And for some people, that just could be a couple $1,000. And for some people, that could be $100,000 that they're keeping on the sidelines, knowing that they have a way to pay bills while the markets work themselves out. Right?
Yep.
Or if you're a real estate investor and you hoped to sell a property at a certain price and that's not available right now, to be able to wait for that.
Yeah. One of the lessons I keep thinking about, especially in bad times, cash is king, especially like real estate, or let's say you borrow money, right,
Mhm.
on a regular basis for your business or personally. one of the things I worked on when I was a bond analyst was working on helping the US Treasury launch TIPS, Treasury Inflation Protection Securities. We used to joke because at the launch, the interest was not that high. And so we used to joke saying that it's like buying flood insurance.
Mm.
The time to buy it when it's during a drought,
When
because
rates are lower. Yeah.
when rates are lower, they want to sell the stuff, but no one is there. So things are cheap. But right after a flood, things are super expensive. Same thing with borrowing, right? When you don't need the money, there's tons of people willing to lend you money.
Mhm.
But when you actually need it, that's when the lenders become really selective. And if you're not like the preferred borrower, you have lots of cash, you have good income, and it's nice and stable, they may not want to lend to you. And that's a problem. I've seen it not just for people, to businesses, to large public companies. I've even seen it for countries. Mexico went through that about 20, 30 years ago, right? The Tesabono crisis. It happens across the board. So when things are good, that's great. But when things are not so good, you better prepare and think ahead and make sure that you're rock solid. We talk about money, in this case, or the emergency reserves. The more aggressive way of thinking about it is, can you raise the cash if you need it? Even if you're fully invested, can you sell something quickly to raise the cash?
Mhm.
Um, and
Or do you have a HELOC on your home?
do you have a
Line of
HELOC?
credit
Yeah.
or
Yep.
personal line of credit, something like that.
Yeah, exactly. And in a sense, you want to get those ducks lined up before you need them, because when you actually need them, forget it. It's going to be a hard,
Mhm.
and time is going to be so tight, and you're going to be stressed out by other things as well.
Mhm.
Be prepared would be the best thing to do.
Yeah, good guidance. How do you think things are going to play out?
I think the longer we stay in this situation, the uglier it's going to be.
By this situation, you are referring specifically to what?
Like say inflation, I'm thinking play out with regard to the recent sell-off in the market,
Okay.
and I guess the economy. That's what I'm thinking about. I would say the longer that inflation's an issue, the longer the Fed has to raise rates, or the longer that inflation continues to accelerate, the uglier things will be.
Mhm.
So if you think back at the start of the year, things were actually benign. Things changed for the Fed in a few months very
Mhm.
quickly. The way I read the Fed was that they know what they're good at and they know what they're not good at. They know that when things are slow, they're not so good at getting things to get going again.
Mhm.
They know how to shut down inflation. They can do it today if they wanted to. But the problem is, if they raise rates to shut down inflation immediately, right? Like jamming on your brakes really fast, they're going
Yeah,
to
you're
skid.
gonna hit the windshield.
You're gonna
Yeah.
hit the windshield. And that's the risk that they run with recession, and also taking the unemployment rate back from 3.6% now back up to 4 or 5%. Don't want
Which is, by the way, the unemployment rate today is, I think, the lowest that it's been in our lifetime.
I think so.
Yeah.
Yeah, that was really impressive. And Fed Chair Jerome Powell keeps mentioning this stat that for every person looking for a job, there are about 1.7 job openings.
Mhm.
Things are tight. Maybe things are changing as we speak.
Right.
There's some companies that have already announced changes. So even for that, in terms of being prepared, don't think that
The job market, it goes in cycles, right?
it goes in
We may have
cycles.
a period now where it's a great time to change careers or find a job, a new job. It's a wonderful time right now where people who are on the edges of the employment universe, who were underemployed, are now fully employed, or who maybe had a hard time finding employment are now finding it easier to get a job. But that goes in cycles too, just with the business cycle.
If you see your stock price and your company's down 50, 70, 60, don't bank on this tightness to continue,
Mhm.
because the stock price is actually information. And maybe things will change in the future, but don't bank on this tightness to stay forever. You don't want to be, the last person standing in the musical chairs. Right now, we're playing this game. They're telling you to sit down, but a lot of people are still running around like nothing's happening. Be careful, because when the music stops, you better not be the last person.
Where do you think the opportunities are right now?
Let's say things are getting bad, right? In terms of business will slow, rates are rising. Some
Right.
companies,
Right. But we're
like,
not in a recession yet. We're not currently in a recession.
no, we're not
Mhm.
currently in a recession,
A little
but
bit on skating on the bottom of a bear market, but not in a
yeah,
recession.
as an investor, you got to do like the Wayne Gretzky thing. You got to skate to where the puck will be.
Mhm.
So right now, we're not in a recession yet,
Mhm.
but at the pace we're going, there's a risk of it. Even if we don't go there
Sure.
fully,
Yeah.
it's highly possible. So 3 months ago, I was thinking, odds are we're not going to go into recession. We're going to go to what I would call a growth recession
Mhm.
or a rolling recession. So growth recession is that goes to like 2%. it's still rising. It's just so slow that it just feels miserable. It makes you feel like we're in a recession.
Mhm.
A rolling recession could be like, usually when we talk about recession, it's about the economy. But if you look at certain sectors or industries, they can have certain cycles. Things can be out of sync where retailers could do well before, now they're really bad. So they're in a recession, they're shrinking. But let's say tech companies are not yet, but that happens at a later time. So they're just going in different cycles.
Mhm.
So rolling recessions, meaning a recession for different parts of the economy or different regions of the country. But right now, the more inflation accelerates, and it could because supply constraints between, supply chain,
Mhm.
between the war, energy prices.
Good.
Of
And
course.
housing, sorry to interrupt you, but housing is 40% of core CPI, right? And
Mhm,
that the gap in household formations and available starter homes is
mhm.
almost 7 million households. That's not going to resolve itself anytime soon.
Housing's a really interesting one, in my opinion. And why? Because, well, rising rates will slow down housing demand. Yes.
Mhm.
Rising rates also makes the cost of building homes go up, which
Mhm.
makes it more challenging. But at the same time, we haven't built any homes in like 10 years,
No.
right?
And all
Yeah.
those people are staying in their rentals, and that's driving up rent prices and
Mhm,
competition for rent, which is great if you're like me and you're a
mhm.
landlord. But on the other hand, that's harder for the person who needs to stay a renter. They need those people to go out and buy their own houses. That rising rent is what contributes so much to the core CPI.
Yeah. And so what the Fed is doing doesn't help that
Mhm.
because the supply is not going to increase. So we have arguably a
Good point.
very tight housing market that's going
Mhm.
to stay tight. Housing is very interesting that way. It's very specialized, unique market, and you need to build. And it's not like you can build things. It takes a day to turn it around.
Can't
It
do it in
takes
3 weeks.
months.
Yeah.
And I'm in San Francisco, and to build anything, in fact, you can't build anything really because they won't give you a permit for it. In fact, it's hard to even build an expansion to your home
Mhm.
because of the permitting process. That plus time and blah blah blah. The lack of supplies,
Mhm.
the lack of try finding a contractor. It's very challenging.
Mhm.
So I'm sure it's different parts of the
Mhm.
country. Housing is very unique in that way. Right now, we need supply. Higher rates are making supply difficult. To me, it's really important to do your homework, work with professionals that do know, that have information or insights about things.
So, what are you telling your clients right now in terms of broad themes of opportunity over, say, the next 12 to 18 months?
Because I'm an economist by training, I say it depends.
That's a
Uh,
great answer. And, and then you can go fight with a bunch of other economists.
each person's situation is different,
Mhm.
and it depends on your priorities and your situation. If you're highly levered, well, odds are that should be your key focus. Meaning you have a lot of borrowing, a lot of debt,
Mhm.
right? The cost of debt is rising.
Either locking in rates or paying down some of the debt.
Locking or in a sense, freeing up cash flow,
Mhm.
right? Because cash is king now, or not
Right.
yet. When it becomes that way, you don't have time to scramble.
Mhm.
You got to prepare for it. If you have a good cash flow and income, right?
Mhm.
Or lots of cash sitting around, it's time to build up your shopping list and look for things that you would may or may not consider in some ways. But this is me being the rational investor where, oh, I want to buy a car or I can buy some investment. I might actually wait on the car if I could,
Mhm. Until
because
prices come down or there's more wiggle room in
in
there
terms of
and
prices
to
come down.
negotiate.
Also, I like the idea of holding assets that will likely appreciate. I know that if I buy a car, the odds are it will depreciate in value. So if I can get something, especially at a lower price, and lower price means higher expected return, I want to focus on that and wait for the big purchase of the
Mhm.
car later if I could. Of course, if you need a car to do your job, that's very different.
Mhm.
But then the question is, how much do you want to spend on it?
Or the $5.70 that I saw in the gas prices to put in the car. Mhm.
Exactly, and things are even higher in
Mhm.
the Bay Area. It's crazy, right? And prioritizing, knowing your resources, knowing
Mhm.
your obligations. So it's basically, before doing too much, step back, know your situation, know what you can commit, and then build your shopping list to the asset of choice
Mhm.
or the debt reduction of choice and go from there. Try not to fall into the trap of the behavioral
Mhm.
stuff and be like, as cold and robotic as possible so you can give yourself or work with someone that could give you an honest evaluation or analysis of where things stand. It's time to be honest,
Mhm.
really.
we can't just be cheerleaders. We have to be clear-headed about what to do or what not to do. Sometimes what we don't do is as important as what we do.
Sometimes the best decision we make is the decision
Mhm,
to not do anything.
mhm. What are you curious about right now, Bill?
It runs the gamut. So I'm very intrigued about the market,
Mhm.
about the geopolitics. I'm worried about what Russia's doing with Ukraine, how that maps into, say, China and Taiwan, and the geopolitical risks there,
Mm.
because we used to rely on Taiwan for a lot of chips. But then at the same time, I was also intrigued yesterday when I was reading about the science of bread. I like to make bread, but I was just reviewing the science of how to manage things and
Uh-huh.
to tweak the bread that you want to make. It's fun. It's an investment of sorts of how to create flavors.
Oh, this is an interesting topic. I want to hear all more about a different time about your bread making hobby. That's very cool.
Hopefully, I can get you a fresh sample.
Oh, yeah. What kind of bread do you bake?
Oh, lately I've been playing around with this Scandinavian rye base bread.
Uh,
It's a bit dense. And I was actually inspired by, I forget the name of it, but you know how in the Grand Central Station, there was, I don't know, still is, this section about Scandinavian food.
mhm.
So I had a wonderful open face salmon sandwich there using this type of bread. So that's been in my head for a few years now.
And so I think that's wonderful that you're curious about bread amongst all the big thinking that you do about the things that impact your clients in the work that you do, the wonderful work that you do. Where can people find you if they want to talk more?
The website is www.candidcap.com. I guess the other way is you just shoot me an email or call me. That's the easiest way to contact me. I try to respond quickly. You can also find me on LinkedIn and Facebook too, but primarily on LinkedIn. And
Perfect. Bill, thank you so much for chatting with me. I really enjoyed our conversation, and we will put some links to the resources in the show notes
okay,
and also where you can find Bill online. So
great.
thanks very
Thanks,
much,
Cynthia.
and I'll see you at our next mastermind.
Yep, absolutely.
All
Okay,
right.
take care.
Bye.
Bye.